My name is Farhan. Today you will solve question number 8 from 2017 past exam. In this question, you will first learn to prepare the balance sheet adjustments at the end of the reporting period. Then you are going to use the results to prepare the income statement and then the current asset section for the balance sheet. You will also understand why a business needs to do budgeting. You can see the question on the left-hand side of your screen, and on the right-hand side you can get to see all the workings which I'll explain step by step. If you need tutoring sessions, make sure to check the link in the description to book a call with me and discuss your requirements. With that being said, let's get started. TP Toys is a new business that will commence trading in July 2018. All sales will be on a cash basis, while all purchases of inventory will be on credit. Credit terms are 5/14 and/30. So we're working with a business that just started trading in July 2018. All sales with customers will be for cash, and all purchases of inventory will be on a credit basis. The credit terms are 5/14 and/30. So what do they mean? 5/14 simply means that we qualify for a 5% discount if we make the payment to our supplier within 14 days. N/30 means that no discount is available after day 14, and we must make the payment to our supplier within day 30. The owner has provided the following estimates for the 6 months ending 31 December 2018. So that is the end of the financial period, which is 31 December 2018, and we are focused for the most recent 6 months. So what we're going to do is, as we read through each and every line, we're also going to understand the workings that we need to do for each of these estimates. So let's start with the first line. Sales, all excluding GST, are expected to be $25,000 per month from July to October, then $45,000 in November, and $65,000 in December. Right. So what this means is that if I want to calculate the total sales excluding GST, we take $25,000 and multiply it by 4. Why 4? Because we know July, August, September, and October, each of these months, we are going to sell $25,000 worth of stuff. Then we add the sale for November of $45,000 and for December, which is $65,000. So altogether, we have $210,000 worth of sales excluding GST. We understand that we are doing the sales on a cash basis with all our customers. So let's calculate the GST that we collect on the sales. You can just simply calculate it by multiplying 10%, which is the GST rate in Australia, with $210,000 being the original sales amount. And that gives us $21,000 as the GST we collect on sales. What does the second information say? So the business will use a markup of 100% on cost. So a markup of 100% on cost simply means that total sales is calculated by multiplying 2 with the cost of goods sold. So total sales of $210,000 that we had calculated in the first working that we have done before equals to 2 times the cost of goods sold. So if I was to use algebra and make cost of goods sold the subject, then I can just simply divide the total sales of $210,000 by 2, and you should get $105,000 as the cost of goods sold. So a markup of 100% on cost basically means that sales is double the amount for cost of goods sold. You can see the total sales excluding GST is $210,000 and the cost of goods sold is $105,000. Now you might wonder why we didn't include the GST on sales here, because the GST that we collect on sales goes to the GST clearing account, which is a liability account that calculates the obligation that we have towards the Australian Taxation Office. So we collect the GST on sales from the customers, and then we are expected to give this back to the ATO. So what about transaction number 3? Stock purchases are budgeted to be $130,000 plus GST. So stock purchases and inventory purchases are synonymous to each other. So if I were to calculate the inventory purchases excluding GST, sorry, that's already given, which is $130,000. And if I was to find the GST on purchases of inventory, I multiply 10% with $130,000, and that is $30,000. So what about the total inventory purchases including GST? That's 130,000 plus 13,000, which is $143,000. The reason I calculated the total inventory purchases including GST is because this is the amount that we owe our creditors or our suppliers or our accounts payable. So let's read the fourth information that we have. Creditors are to be paid promptly and the discount will always be taken. The creditors' control balance at 31 December 2018 is estimated to be $15,000. So in the old curriculum, we used to call accounts payable as creditors' control. So creditors' control refers to the credit suppliers, who are now what we refer to as the accounts payable. So I have drawn a ledger account for accounts payable. So accounts payable refers to the credit suppliers of the business. So obviously this is a liability for the business. All liabilities by default should have an opening balance on the credit side and a closing balance on the debit side of the ledger account. Liability is also when they increase, we credit them, and when they decrease, we debit them. So within the ledger account, we understand that this is the debit side and this is the credit side. So you can see the opening balance here is zero. Why is this zero? Because we started the business in July 2018 and we didn't have any accounts payable to begin with. Then you have the closing balance on the debit side of $15,000 based on the information that we're given here, that the creditors' control balance at 31 December 2018 is estimated to be $15,000. Next, if you check the credit side of the ledger account, you will see that we have included the total inventory purchases, including GST, which is $143,000 based on our calculations for the third information, where the original inventory purchase was $130,000 and the GST on purchases of inventory was $13,000, and together these two gave us $143,000. So this is the amount that we owe our accounts payable. The reason this is on the credit side is because this increases our obligation towards our credit suppliers. And when liabilities go up, we know that we credit them. So that is why, because the obligation is increasing, we're crediting this within the ledger account for accounts payable. All right. So we know based on the question that we always take our discount. Okay. So if I was to balance the debit side with whatever deficit we're left with, how should we determine that? So you take a glance and you know the heavier side is the credit side. So the total for the credit side is $143,000, which must be the total for everything on the debit side as well. So once you subtract the closing balance of $15,000 from the total of $143,000, the deficit we have is $128,000. All right. So here you will see that I have included two elements, discount revenue and bank. And you will understand why I have done that. So we understand that the deficit on the debit side is $128,000. We also understand that the discount is always taken based on what's mentioned in the question. We know that the discount is 5%. So 5% of $128,000 is $6,400 as the discount revenue, or the discount that we expect to receive from our suppliers, which means we are making 95% of this amount as payment to our suppliers. So 95% of $128,000 is $121,600, which refers to the payment that we'll make to our accounts payable, and 5% of $128,000 is $6,400, which refers to the discount that we expect to receive from our suppliers. So let's just finish this ledger account that we have constructed. So discount revenue is $6,400, which was calculated by multiplying 5% on $128,000. And then the remaining 95% is the payment that we're making to our accounts payable, which was $121,600. And both of this combined gives us $128,000. Okay. So We'll need all this information when we answer the questions, so we'll come back to all these workings eventually when we prepare the financial statements. Now let's move to point number 5. Wages expense is expected to be $7,000 per month, payable fortnightly. An accrual of $144 will be required for wages on 31 December 2018. Right, so we know that we are working with a business with the 6 months that ended 31 December 2018. And given that we know that wages expense on a monthly basis is $7,000, then the total wages expense for 6 months would be $7,000 multiplied by 6, which is $42,000. And all expenses are what we report within the income statement. Okay, so the total wages expense of $42,000 is what we're going to report in the income statement. Now, we also understand that at the end of the period on 31 December 2018, we are going to accrue wages of $144. So accrued wages refers to a current liability, which is what we report in the balance sheet. So if we know the total wages expense is $42,000 and the accrued wages is $144, that means the wages that we have actually paid for in cash or using our funds from the bank account is $42,000 minus $144, which is $41,856. We didn't need to calculate that, but the reason I calculated this is to make sure that you understand that if we were to prepare the operating activities section for the cash flow statement, we are going to show $41,856, which is the amount that we report in the cash flow statement as the operating activity. Okay, so that is the main reason why I separated this. So $42,000 is the total wages expense that goes to the income statement. Accrued wages of $144 is what we show as current liability in the balance sheet, and wages paid in cash is $41,856, which is what we report in the cash flow statement as an operating activity. Okay, so let's move to point number 6. Advertising of $2,000 plus GST will be paid in July 2018. All right, so let's start with the first line that we have. So if we are paying $2,000 in July 2018 for advertising, and because advertising is basically a service that we are going to take from one of the advertising people, if the GST on advertising can be calculated by multiplying 10% with $2,000, which is $200. And just have this thought in mind that the advertising paid in July is $2,000. The second line says that a further $9,000 plus GST will be paid in November for a 3-month advertising campaign commencing 1 December 2018. All right. So in November, we are going to prepay advertising of $9,000 for 3 months. All right. And the GST that we are going to pay for the service that we're going to take is 10%, obviously, multiplied on $9,000, which is $900. Now, we know that this advertising campaign is for 3 months, and it's going to start in 1 December. So this advertising of $9,000 covers the month of December 2018, January 2019, and February 2019. We're working with the business where the financial period is ending 31 December 2018. That means 1 month of advertising must be expensed. So that 1 month that is expensed, how much is that amount? So if the advertising of $9,000 covers 3 months, then the monthly advertising expense is $9,000 divided by 3, which is $3,000. This means the total advertising expense from this amount that we paid in November is $3,000, which is basically covering the month of December. Okay. Now, if I want to find the total advertising expense for 6 months together ending 31 December 2018, it's the $2,000 in advertising that we prepaid initially in July 2018, plus the $3,000 in advertising expenses that we have incurred for the month of December, and that is $5,000 in total. So the total advertising expense the business consumed is $2,000, which refers to the payment we made in July 2018, the economic benefits of which has already been consumed, and $3,000, which is the advertising expense portion for the 1 month of December. And together, this gives us $5,000. We do not include the GST we pay on advertising as part of the expense calculation, because total advertising expense of $5,000 is what we're going to report in the income statement, but any GST that we pay on advertising is basically going to the GST clearing account on the debit side of the GST clearing account, because any GST that we are paying, we can claim that against any GST that we're collecting on sales. And then we calculate the net amount and the settlement before we transfer the amount to the ATO. So we don't have to worry about that now, but you just need to calculate these amounts because we need to use this eventually. The GST paid of $900 and then the GST initially paid of $200, okay? Now, I also want to find the prepaid advertising, the economic benefits that are still left to be consumed at 31 December 2018. Now, we understand that the $9,000 that we have paid in November was for 3 months, starting 1 December 2018. And given that we are working with a business with a financial period ending 31 December 2018, this means that the economic benefits that comes with the prepaid advertising for the month of Jan 2019 and February 2019 still has not yet been consumed. This means these are the current assets of the business at 31 December 2018. So the prepaid advertising should be for 2 months. So $6,000 altogether for Jan 2019 and February 2019, which are reported as current assets in the balance sheet. Okay? So be careful with what you understand, because if you get this right, you will get full marks for sure in the exam. So let's move to the next point, which is point number 7. Insurance for the first year will be $8,400 plus GST to be paid on 1 July 2018. Okay, so we know the prepaid insurance at 1 July 2018 is $8,400, and the GST that we would pay on this insurance would be 10% off $8,400, which is $840. So prepaid insurance, so if you read the question carefully, it says insurance for the first year. So obviously this $8,400 covers 12 months in total. And this payment was made on 1 July 2018. Given that we are working with a business which has a financial period ending 31 December 2018, and we're focused on the most recent 6 months of trading, this means that half of this $8,400 would be expensed at 31 December 2018. So half of $8,400, we would already consume these economic benefits by 31 December 2018, and therefore we can expense this. So the insurance expense for the 6 months would be basically $8,400, which is the 12-month insurance, and just divide it by 2 to expense for the 6 months, and that's $4,200 in total. Okay, so this $4,200 in insurance expense for the 6 months is what we're going to report in the income statement. And the prepaid insurance at 31 December 2018 of $4,200 refers to the remaining 6 months, which is a current asset for the business, because we still have economic benefits of $4,200 that we haven't consumed yet, and we'll be consuming this in 2019. But that's not our concern, because the reporting day at the moment is 31 December 2018. Okay? So let's move to point number 8. Shop rent is $2,000 plus GST per month, payable 4 months in advance, with payments due on the first day of July, November, and March each year. So here I've drawn a timeline, and based on what we have just read, we know that we pay for rent 4 months in advance. We pay on 1 July, we pay on 1 November and 1 March. 31 December is the reporting day at the moment. Okay? So if the monthly rent is $2,000, and given that we pay for 4 months in advance, then on 1 July, we will be paying $8,000, which is basically $2,000 multiplied by 4, covering 4 months. And then we pay $8,000 again in 1 November, and again $8,000 in March next year. But we're not worried about that at the moment. So let's break it down. So on 1 July 2018, we will pay $2,000 for 4 months, covering each of the 4 months, and that's $8,000 in total. And this covers July, August, September, and October. So the 4 months that we're talking about. This should be fully expensed at 31 December 2018. All right. So this $8,000 covering 4 months of rent would be fully expensed at 31 December 2018. And let's calculate the GST that we will pay on this rent, and that's 10% multiplied on $8,000, which is $800. Then we are making the rent payment again on 1 November for 4 months, and that's $2,000 per month multiplied by 4 months, and that's $8,000 in total. And this payment of rent on 1 November should cover November, December, January, and February. All right? We are only concerned with November and December in terms of expensing the rent, because this falls in the current financial year ending 31 December 2018. So November and December, if we are expensing for 2 months, and given that the rent on a monthly basis is $2,000, then for 2 months, it's 2,000 multiplied by 2, which is $4,000. Okay? Let's calculate the GST paid on rent again, and that's 10% multiplied on $8,000, which is $800 in total. Now, so let's calculate the total rent expense for the 6 months ending 31 December 2018. So we are expensing $8,000 entirely, which is coming from here, that the payment we're making on 1 July, which covers July, August, September, and October, and these amounts should be fully expensed. And then we get $4,000 for the month of November and December with regards to the rent payment that we have made on 1 November. Okay? So altogether, the total rent expense is $12,000. Now, what about the prepaid rent, the economic benefits that are still left for the business in terms of rent at 31 December 2018? So this should be for the month of Jan and for the month of February 2019. All right? And that's $4,000 in total. And prepaid rent is a current asset, which is what we're going to report in the balance sheet, and that is $4,000. All right. So what else is left? So the last additional information. So shop fittings costing $45,000 plus GST will be purchased on credit, and you are given the source document, which is the invoice number, and ready for use by 1 October 2018. The shop fittings are expected to have a useful life of 5 years and a residual value of $15,000. The shop fittings will be depreciated using the straight line method. Okay, right. So before we start the calculations, what do we understand by the residual value? So the residual value is the expected disposal proceeds at the end of the useful life of 5 years for the shop fittings, after we have consumed all the economic benefits that comes with these shop fittings which we have purchased, which is for 5 years. We can expect to sell the shop fittings for $15,000. So that's what we understand by the residual value. Now we understand that we have purchased this on 1 October 2018, and we are working with a business at the moment which has a financial period that ended on 31 December 2018. So from 1 October 2018 until 31 December 2018, we have 3 months in total, the month of October, November, and December. So this asset, these shop fittings, were only in use for 3 months in the current financial period ending 31 December 2018. Given that we're using the straight line depreciation, let's find the depreciation on an annual basis. So if I want to find the depreciation on an annual basis, I use the formula cost minus residual value, which is the depreciable amount, divided by the useful life. So the cost is $45,000 minus $15,000 in the residual value, divided by the useful life of 5 years, and that's $6,000 per year as the depreciation we have for the shop fittings. So on a monthly basis, this depreciation would be simply calculated by taking the annual depreciation of $6,000 and dividing by 12, which is $500. So if we get 3 months in total for this asset which has been used in the current period, then for 3 months, the total depreciation would be $1,500. All right, so you can see as part of the cost, I didn't include the GST. Why? First of all, this asset was purchased on credit. And secondly, this GST that we would pay on the shop fittings doesn't form part or basis of the cost, because this is GST paid on purchase of assets, which is what we show in the GST clearing account. And when we show this in the GST clearing account, we're going to show this in the debit side of the GST clearing account to reflect a reduction in liability or the amount that we owe to the ATO. All right, so do not include the GST as cost, because the cost is only the cost of $45,000. GST paid on this asset, or what we'll be paying on this asset eventually, is what we will be able to claim back from the ATO or offset against the GST settlement amount that we will owe to the ATO eventually. All right, okay, so I have also calculated something here, which is the closing inventory that we expect to have at 31 December 2018. And it's a very simple explanation here. So we know that the total inventory that we purchased, excluding GST, is $130,000. Where did we get this information from? Check the third line here. Stock purchases are budgeted to be $130,000 plus GST. GST on inventory is not part of the inventory valuation, because as we understand, GST paid on inventory is something that we are going to include in the GST clearing account and use that to offset the net GST that we owe to the ATO. So if we purchase $130,000 worth of stuff during the year, and we know the cost of goods sold is $105,000, the cost of goods sold basically refers to the cost of the inventory that we sold to our customers. So obviously, whatever inventory we sell to our customers, we sell it for a profit. But also at the same time, those inventory has a cost. And that cost refers to the price that we expect to pay our suppliers, right? So the difference between the purchases of inventory of $130,000 and $105,000 is the cost of goods sold, which is $25,000 left in inventory, closing inventory. And that's what we report as current assets in the balance sheet. Okay, so let's start with the first requirement of the question. Calculate the estimated discount revenue for the 6 months ending 31 December 2018. We have already calculated this before when we prepared the ledger account for accounts payable. And if you remember, we found the discount revenue to be $6,400, which was basically the 5% that we multiplied on $128,000, that was $6,400. So this is the discount revenue. The second question requires us to prepare the budgeted income statement for the 6 months ending 31 December 2018. All right, so I've already prepared this in advance, so let me explain you. So we know the sales are $210,000. All right. We do not include any GST stuff within the income statement. That's only part of the GST clearing account and the balance sheet. So the sales excluding GST is $210,000. Then we have the cost of goods sold of $105,000 based on the 100% markup. All right. So once you subtract the cost of goods sold from the sales, you get gross profit of $105,000. Sales minus cost of goods sold equal to gross profit. Then we add other revenue or any other income, We have discount revenue of $6,400. If you had a profit on disposal of non-current asset, you would also include that, but we do not have that in this case. And then you get $111,400, right? Then we subtract all the expenses, starting with the wages expense, and that was $7,000 on a monthly basis for 6 months, which is $42,000 in total. Then we have advertising expense of $5,000, which we had to go through a lot of complications to find. So total advertising expense for 6 months ending 31 December was $5,000. Then insurance of $4,200 was basically the expense amount for the 6 months, right? And then we have rent expense of $12,000 based on point number 8, where we had to go through lots of workings and we found the total rent expense to be $12,000. Lastly, we have the depreciation of shop fittings, which refers to the depreciation for the 3 months of usage in the current financial period ending 31 December 2018, and that was $1,500. And that's all the expenses that we've got. So you'd add all the expenses together, which is $64,700. So obviously you're going to subtract the total of expenses from the adjusted gross profit of $111,400. And then you arrive at $46,700, which is the net profit. All right? Okay. The next requirement of the question is to prepare the current assets section for the balance sheet. So remember, we were going through a lot of workings and we've calculated the amounts for prepaid separately every time. So starting with the first one, that's prepaid advertising, which is $6,000 for 2 months of Jan 2019 and February 2019, which is the next year, given that we're working with a business which has a financial year that just ended at 31 December 2018. So the prepaid advertising is $6,000. Then we got prepaid insurance at 31 December 2018 of $4,200. And then we have prepaid rent expense as well for the month of Jan 2019 and February 2019, and that's $4,000. And lastly, we're including the closing inventory of $25,000, which is what we have calculated at the end. Again, let me explain you how we got that. So the total purchase of inventory, excluding GST, we don't care about GST here because, as you understand, that's something that goes to the GST clearing account. So inventory purchases excluding GST is $130,000, and we subtract $105,000, which refers to the cost of the inventory that we have already sold to our customers. So this inventory is not in the books anymore. So the difference between $130,000 in purchases minus $105,000, which refers to inventory that we have already sold, and we're left with $25,000 in inventory. So that's what we have included here. So you can add all of this and find the total current assets, but you're not really required to do that because, as you understand, we are preparing an extract. All right, so let's see what's the last question about. So explain how budgeting improves control within a business. All right, so budgets can help a business formulate a plan or a strategy. The reason we need a plan or a strategy is because we have short-term business objectives and then we have long-term business objectives. But we need to fulfill our short-term business objectives so that we as a business have that momentum to go on to achieve the long-term objectives eventually. So one of the reasons for why budgeting is important is because it helps us to formulate a plan or a strategy in achieving our objectives. Then when it comes to budgeting, we set aside some amounts for expenses. All right. So what we do is once the actual results come out, we compare the budgeted amounts with the actual results, and we identify any potential problems or any deficiencies or any inefficiencies. We can explore various reasons for why our actual targets were adverse or unfavorable compared to the budgeted targets that we have set aside. And if we understand the reasons for all these differences, then we can work on those and increase our efficiency and improvement. Lastly, budget can also help us control our spending so that we can hit our target profit objectives, because most of the cases you're working with a business where as managers you will have to ensure that you have enough profits, so that enough profits after all the expenses are taken care of, so that you can distribute those profits to your shareholders or also use part of those profits as reinvestment purposes for next year. So these are many of the reasons for why budgeting is important for the business, and you can easily get full marks. It's just 2 marks. I don't see a reason for why you won't get it, and that's as simple as that. So that's all for today's lesson. I believe you found a lot of value in this content if you have watched all the way until the end. Make sure to like this video and subscribe to this channel. And if you need tutoring sessions, check the link in the description to book a call with me and discuss any requirements that you have. I'll see you in the next lesson.